Tesla is not slowing down, it's shedding its training wheels, and the headlines from the past few days make that very clear. Hi, this is Ken. Today, I want to break down what really happened between March 1st and early March 4th. Not just the headlines, not the emotional reactions, but the structural shift that I believe is unfolding right now. If you are a Tesla owner, this week tells you how close we may be to a new phase of autonomy. If you are a TSLA investor, this week tells you where future margins and competitive advantages will actually come from. And if you are trying to decide whether Tesla is stalling or evolving, this is the moment to zoom out. Because when you look at the pieces separately, it feels messy. But when you look at the structure, it becomes surprisingly clear. Let's start with what I think is the most important development. FSD has now surpassed 8.4 billion cumulative miles. For years, we've heard about the psychological and technical benchmark of 10 billion miles as a meaningful threshold toward unsupervised autonomy. Tesla is now within striking distance of that number. This is not just a vanity metric. In AI, data is power, and not all data is equal. Real-world driving data collected across continents, weather conditions, road types, and human behaviors is exponentially more valuable than simulated data. Tesla's fleet is effectively a global data engine. Every mile driven by customers becomes part of a reinforcement learning loop. That 8.4 billion number represents compounding experience. The question is not whether autonomy is difficult. It is. The real question is who has the deepest data set and the fastest feedback cycle. Right now, Tesla is widening its moat in a way that is difficult to quantify quarter by quarter. If the pace continues, 10 billion miles may not be that far away, and that milestone, psychologically and regulatorily, could become a narrative turning point. Now let's talk about something that surprised many people, the Cybertruck price increase. The dual-motor AWD variant launched at $59,990. Roughly 10 days later, it moved to $69,990, a $10,000 jump, about a 17% increase, with deliveries stretching into 2027. Some observers immediately assume this signals confusion or instability. I see it differently. You do not raise the price of a product by $10,000 unless demand gives you that flexibility. For the past couple of years, Tesla has been associated with price cuts, margin compression, demand stimulation. This move signals something else, pricing power. Brand strength allows pricing flexibility, and pricing flexibility protects margins. For owners, this suggests stronger residual value stability. For investors, this opens the door to gross margin recovery in future quarters. Cybertruck is not just a vehicle, it is a margin lever and a brand amplifier. And this week, Tesla demonstrated that it still has control over that lever. Next, Europe. For months, we've seen headlines suggesting Tesla is losing momentum across European markets, but February data tells a more nuanced story. Norway up roughly 75% year over year, France up around 55%, Spain up about 74%. Does this mean everything is fixed? No, but it clearly shows that demand did not disappear. It fluctuated. European registrations are highly sensitive to incentive timing, logistics cycles, and model refresh cadence. Looking at 1 weak month and declaring structural decline is intellectually lazy. What I see now is early evidence of rebound. If this continues into the next quarter, the Tesla collapsing in Europe narrative begins to weaken significantly, and narratives matter, especially for valuation. But this week was not all positive. We learned that Toyota and Stellantis are exiting the EU CO2 pooling arrangement. That has implications for Tesla's regulatory credit revenue in Europe. We have already seen regulatory credit tailwinds fade in the United States. If Europe follows, that supplemental income stream narrows further. On the surface, this looks like a negative, and in the short term, it is. But I want to frame it differently. For years, critics argued Tesla relied too heavily on regulatory credits. As those credits shrink, Tesla is forced to stand purely on operational strength, vehicle margins, energy expansion, software monetization, robotics. In a strange way, this is a maturation phase. The training wheels are coming off, and that can feel uncomfortable. But long term, a company that survives without subsidy dependence is structurally stronger. Another risk worth watching is semiconductor supply. There are reports of delays at Samsung's Texas facility where future AI5 and AI6 chips are expected to be produced. These chips are critical for scaling FSD and potentially for Optimus development. AI ambition requires hardware reliability. If manufacturing timelines slip, AI deployment timelines can shift as well. This is one of the few real execution risks visible this week. Investors should watch supplier updates, capital expenditure patterns, and any signals of diversification in chip sourcing. Tesla's AI strategy is aggressive. Execution discipline will determine how smooth that transition becomes. Now let's zoom out to the macro layer. Tensions in the Middle East are pushing oil prices higher. There is renewed discussion about gasoline potentially moving toward $5 per gallon in parts of the United States. Historically, rising gasoline prices accelerate EV adoption. Consumers do not calculate ideology. They calculate total cost of ownership. When fuel costs spike, the economic argument for EVs strengthens almost immediately. This is an indirect tailwind. It does not show up instantly in quarterly deliveries, but it influences buyer psychology and long-term demand curves. Macro volatility today could quietly reinforce Tesla's demand tomorrow. So where does that leave us? On one side, we have 8.4 billion FSD miles, pricing power in Cybertruck, and early signs of European recovery. On the other side, we have shrinking regulatory credit support and potential semiconductor execution risk. And the stock is currently trading under $400, around $391 in a broader market pullback. This is what transition looks like. Tesla is moving from a subsidy-assisted EV disruptor to an AI-driven industrial platform. That shift is not linear. It will include volatility, skepticism, and mispricing. But I want to leave you with one deeper question. Do you still view Tesla primarily as a car manufacturer, or do you see it as an AI infrastructure company monetizing mobility, energy, and eventually robotics? If you only track vehicle unit growth, you may feel uneasy. If you track data accumulation, AI training scale, and vertical integration into hardware, the story becomes very different. We are in a transitional chapter, and transitional chapters rarely feel comfortable in real time, but historically, they are where long-term positions are built. As always, my goal here is not to hype and not to fearmonger. It is to analyze structure over noise. If you found this breakdown useful, make sure to subscribe. We analyze Tesla from a long-term perspective here, not just headline reactions. Thank you for watching, and let's continue enjoying life in the future. Before we wrap up, let me take a moment to introduce myself. I drive a Tesla Model Y, and at home, I've installed a Tesla Powerwall, so I actually charge my car with solar energy. I truly believe Tesla is shaping the future, and that's why I share the latest news and insights here on this channel. I'm from Japan, but I want to connect with Tesla fans all around the world. That's why I also create an English version of my videos. YouTube now lets you switch the audio into your own language, so you can enjoy it in whatever language you prefer. Most of all, I'd love to connect with Tesla fans everywhere so we can support Tesla together. I also share updates on X, so feel free to follow me there and let's connect. And if you haven't already, please subscribe to this channel. I'd really appreciate it. Thanks for watching, and I'll see you in the next video.